This week at the zoo, we saw a huge market rally amidst growing optimism that federal stimulus would successfully prevent a financial crisis. Hello and welcome back to the Wall Street Petting Zoo. I'm Robert Coburn.
And I'm Chris Smith.
And this is our This Week at the Zoo segment, our weekly review of market news. This week, we'll dissect the market rally and discuss whether it's sustainable or whether it's a trap for the bulls.
Yeah, this week, Robert, we started the week on Monday with a 3% loss due to news over the weekend that huge numbers of unemployment claims were being filed all over the country, including New York and California. And the 3% drop came despite news over the weekend that the stimulus package would include $2 trillion of congressional funding rather than just $1 trillion. So it was twice as large as expected in terms of congressional funding, and that it would also include $4 trillion of additional quantitative easing by the Fed. So overall, the whole package was about $6 trillion, which again, that's quite a bit larger than what markets were expecting. And in fact, on Monday morning, the Fed said that quantitative easing would be unlimited. And the Fed also announced that for the first time, the Fed will buy company debt, corporate bonds, and ETFs, corporate bond ETFs. So the Fed is not just giving loans now, it's actually buying assets in order to support the collapsing prices of corporate bonds and mortgage bonds. So the Fed is getting in the investment business. We're not really sure what this is going to mean down the road, but for the moment, it is providing a little bit of support to some of the riskier assets out there in the market in terms of their prices. But despite all of that stimulus, the market reacted negatively on Monday, specifically because they were focusing on those unemployment numbers on Monday.
However, Tuesday rolled around, and can you say rally? The Dow posted a huge 9% rally. Leading the way were the energy and travel sectors, as well as bank stocks. It was the fifth best percentage gain in the history of the Dow, but after the stock market was beaten so far down, it's like being glad you won $2 on a $20 scratcher. Partly the rally was driven by President Donald Trump's comment Monday night that he hoped to reopen American businesses by Easter, and partly the rally was driven by optimism around federal stimulus as details on the package emerged and the quantitative easing by the Fed started to take effect. Last week, we saw a huge deflationary spike in the dollar, but this week the dollar reversed course and plummeted due to the trillions of dollars of money printing by the Fed.
Yeah, so let's pause here to talk specifics on the stimulus bill. There are three potential triggers for a financial crisis that we've been watching. First of all, large corporations might start to default on their $10 trillion of corporate debt. That really has been the biggest risk out there in the economy, and that's the one that everybody sort of expected to trigger a financial crisis. Secondly, American households might start to default on their mortgages. Mortgages have been getting riskier and riskier over the last few years. And third, small businesses might default on their commercial mortgages. We've seen a lot of small businesses laying people off, defaulting on their mortgages, going out of business. Cheesecake Factory announced this week that they're not going to be able to pay rent this month. And commercial mortgage bonds have been getting sold off at pretty unprecedented rates this month. So there for a few days, it was looking like commercial mortgages might be what would kick it off. But the federal stimulus does a pretty good job of shoring up all three of those potential failure points. The Fed has set up systems to lend trillions of dollars to large corporations so that they can borrow more money to pay their giant corporate debts. The stimulus package expands unemployment benefits and sends checks to every American to make sure that people can pay their mortgages. I shouldn't say every American that qualifies, to make sure that they can pay their mortgages. And it also offers free money for small businesses to spend on payroll and rent. Essentially, the way this works is they're offering business loans to small businesses, but as long as they pay it for payroll and rent, those loans are going to be forgiven. So as long as the help actually gets delivered fast enough, these measures should prevent any of the three major triggers from sending us into the financial crisis that we've been worried about. So I think, a market rally here was justified because of the way that the federal government has mitigated those risks. Wednesday, the stock market continued to climb on news that the White House and Senate lawmakers had struck a deal on this bill. But the market did taper off a little bit near the end of the day after Senator Bernie Sanders threatened to hold up the bill after he called out lawmakers on a $500 billion corporate welfare fund. So we ended the day up about 1.5% on Wednesday, so kind of a modest continuation of the Tuesday rally.
Yeah, and Thursday the rally continued with the Dow gaining about 7.5%, despite a jobless claims report that showed 3.28 million jobs last week. Chris, I believe you were guessing 2 million based on early numbers, and I was guessing around 6 million based on my gut.
Yeah, I guessed 2 million on the episode last week. And then on Wednesday, I announced on Twitter that I was revising my estimate up to 3 million after I saw that California alone had 1 million claims. So I actually turned out to be pretty close to the mark.
Yeah, the number was 3.28 million, and you would think this would cause panic in the stock market, and well, it didn't, as the Dow posted a 1,300 point gain. What helped the market was that the unemployment numbers almost don't matter because the stimulus bill expands unemployment benefits so that a lot of people will make more money on unemployment than they did at work. Airline stocks got an especially big surge due to news that the stimulus package would include bailouts for airline and aerospace companies. However, one big risk emerged on Thursday as oil prices dropped 4.5% on reports that the world is running out of storage space for excess oil production. If oil storage does run out, energy companies will have to choose between stop production or selling oil at a much cheaper price. Some analysts project that oil prices could drop to half their current level. That's probably why you see gas prices so cheap around the country.
Yeah, that's right. I actually was a little bit surprised to see how strongly the airline and aerospace companies rallied because they have been sort of expecting free money, but it didn't end up being free money. Essentially, what the government is doing is offering to buy equity in those companies. So again, we're seeing the government get into the investing business, which makes me a little bit uncomfortable. But yeah, so I mean, this is going to supply some liquidity to those companies, I guess, if they want it. Boeing turned it down. Essentially, they said, we have lots of other options for funding, so we'll go get it somewhere else. So, like, I don't really know that big rally in airline stocks was warranted because I don't think that the help they're being offered is actually that good. But anyway, oil prices continued downward Friday, another 7.5%. And it looks like we will retest $20 per barrel next week. We're pretty close to $20 per barrel right now. And the market followed oil downward with a 4% drop in the Dow Jones Industrial Average. And in addition to weak oil prices, we also saw accelerated spread of COVID-19 and U.S. healthcare system starting to be overburdened as we went into the weekend. So despite the drop, we ended the week on an indecisive note. We're slightly above the 10-year trend line, which actually puts us in bull market territory. And there are some analysts out there saying, oh, we've entered a new bull market. But Friday's drop hints that the rally may have peaked. It wasn't a big enough drop to give any clear technical indication about what might happen Monday. It's totally possible that the rally could resume in a more modest way next week. But I personally am a little bit bearish on the market right now. I suspect that we break below that 10-year trend line and resume the downtrend next week.
Yeah, let's talk about what the risks are as we move forward from here. One huge risk here is oil prices. If oil prices fall below $20 per barrel next week, look out below for both oil and U.S. stocks. One way we might avoid oil prices dropping like a rock to $10 per barrel is if Saudi Arabia and Russia reach a truce in their price war over the weekend. You'd think that it would be a rational thing for them to do, but these are totalitarian regimes we're talking about, so who knows if they will do the rational thing.
Yeah, I'm not convinced that they're going to call it off. I thought a couple weeks ago that Trump might talk them out of it, but he doesn't seem to have had any success yet in convincing Saudi Arabia to back off this oil price war. So another risk I see is that if Trump gives the order to reopen the economy, as the market seems to expect now, the state governors may refuse to go along with it. California and New York, of course, have a couple of the biggest economies in the nation. And they're also the least likely to follow a White House directive to send people back to work because, of course, they're liberal states, and the liberals have been much more in favor of continuing the quarantines than the conservatives have. So I think that we could see, Trump give that order and essentially non-compliance from the governors.
And then there's the fact that the economic data is probably going to be bleak for a while. If unemployment continues to rise despite the stimulus package, stocks may fall. If earnings and guidance numbers come in lower than expected, stocks may fall. And if companies suspend or cut their dividends, stocks may fall. If the U.S. government's credit ratings gets downgraded because of how much money we just borrowed and how many bad corporate bonds we're buying, stocks will definitely fall. And even if stimulus works as intended here in the U.S., the global economy may slow down, which would have a ripple effects on the American economy.
Yeah, I think that probably there's going to be a lot of attention to economic data and a lot of attention to earnings in the next few months. And what's going to determine whether we're in a new bull market or a continued bear market is going to be how good or bad that economic story looks. So it's time to start really watching those numbers. Another risk I would note is that if Trump does reopen the economy by Easter, that will be great for most of the economy, but it'll be terrible for health insurers because it's very likely we'd see a big surge in coronavirus cases, and health insurers will bear the cost of treatment. So in the second quarter, we could see health insurance earnings take a big hit as a result of sort of reopening the economy a little bit too early. And so it might take them a lot longer to recover than the rest of the market if businesses do go back to work early.
Yeah, and banks might take a while to recover too. A lot of banks have been giving people holidays on paying their mortgages, which means banks are eating a loss in the first quarter. And with the Fed's interest rate target at 0, bond yields negative, and the Fed buying mortgage bonds to push down mortgage rates, it's hard to see how banks will make a profit until fiscal policy goes back to normal.
Yeah, so lots of risks out there. I don't really think that a new bull market is justified given how many risks are out there, which is why I say that I'm bearish on stocks. But I do think that as we resume a downtrend, it's probably going to be a slower downtrend than what we saw in the last couple months. All right, let's talk about these stocks that we watched this week. What were you watching, Robert?
So last week I was watching PEZ, which like most ETFs and stocks this week jumped in the middle of the week before receding on Friday. Activision, Blizzard, Tencent, and Zynga, the three gaming stocks I've been watching for the last couple of weeks, also ended the week higher than it started. I know I said I wasn't going to buy into anything, but I'm sure you know how it feels to have a pocket full of cash in a down market. So I did end up buying, but instead of PEZ, I bought into TPOR on Monday. This transportation ETF was battered pretty hard, as it had both rail and airliners in its holdings, but the ETF fell below $5 and $5 a share on Monday, as airliners and rail are most likely going to be bailed out as they are essential to recovering the thriving economy. So what stocks were you watching, Chris?
Well, last week I recommended staying mostly in cash, although I did think that stocks would get a rally early in the week, followed by a sell-off on Thursday and Friday. I did buy a few things going into the rally, and stocks did rally. The sell-off that I expected on Thursday didn't really materialize until Friday, so I got out of that stuff before the really strong rally on Thursday for the most part. I had thought about taking a short position on banks ahead of the Thursday unemployment number, but the more that I thought about the stimulus package and how it would mitigate the unemployment stuff, I decided not to do that. And I'm glad I decided not to, because banks gained 6% on Thursday, so that would have been a bad bet for me. One thing that I did pretty well in this week was oil tanker stocks. And I will talk about that a little bit when we talk stocks that we're watching this week. What are you watching this week, Robert?
So this week I'll be keeping my eye on Bitcoin. The infamous halving is quickly approaching, as we are about a month and a half away from the projected May 13th date.
And tell us again what the halving is.
So the halving is essentially every time a Bitcoin is mined through millions and millions of computers that are online right now. Essentially, they're allotted right now, I think, for every successful Bitcoin, there's 6.25 Bitcoins that split between the groups of computers that completed an algorithm. And so when the halving occurs, this is going to drop in half. So instead of it being split 6.25 Bitcoins, it'll be split, I think the number is 3 point something. So in other words, the amount of Bitcoins going into the pool of Bitcoins that are available will basically be reduced at a slower rate. I think they projected, based on hash rates, which is the speed at which Bitcoins are mined, that the last Bitcoin will be mined in 2140 is the year that it will be. The last one should be mined if everything is projected. But anyways, the halving has occurred 3 times already. We should see a lot of volatility, leading to what a lot of Bitcoin analysts project to be another huge rally, as the last 3 occurrences have caused a year-long bull rally, seeing returns of 18,000, 9,000, and 3,000% respectively, before dropping roughly 86% over the course of the year following the bull market rally. So there's basically, it looks like there's a trend, so it may not jump 18,000 this time or anywhere near 3,000 this time. I'm pretty sure it'll probably jump maybe even 1,000% if it does. Again, there's a lot of hype going around with Bitcoin, so that's why I say there's a lot of volatility with this. There's a lot of people who don't believe in Bitcoin in terms of its value, and so there may be nothing that happens in May when the halving occurs. But historically, the last 3 times there have been huge gains that have been seen for about a year after the halving occurs. So definitely there's a lot of data behind it, but at the same time it's a lot of hype as well.
Yeah, I'll confess to being one of those people who doesn't really believe in Bitcoin, but if I understand you correctly, you're saying basically demand is going to remain the same, but supply is going to get reduced as a result of the halving, and so we should see the price increase. Is that?
Yeah, so I think a better way to put it is like, if let's say you had a gold mine, and every day you were able to pull like 6 gold nuggets out of the gold mine every day. Basically, after May 13th, what would happen is you would go in the gold mine every day and only be able to pull out 3.
Yeah. So the supply isn't being reduced; it's just the growth of supply is being constrained.
Yes, and this happens every time there is a. I think after 1,000 or so. I have to go back and read over how often it occurs, but the last time it happened was 2016, if that's to give you any context of how often this happens. So it's been about 4 years since the last happening occurred.
Okay.
And also, we had a viewer request to look at cruise liner stocks. Now, it's no secret that right now they are taking a huge beating, as cruise ships are all over the news with passengers being stuck in quarantine. There was the infamous one that was I believe it was in Santa Cruz for a while before it was allowed to port in Oakland. And basically passengers are just being stuck and then getting sick. And then the government literally did them no favors this past week when it was announced that cruise liners will not be receiving stimulus relief. So this is not good, as the major companies, Royal Caribbean, Norwegian, and Carnival, were in expansion mode. So they already have ships that they have bought. They have a lot of debt. So if they were having trouble paying debt before, they are definitely going to have a problem now with no revenue coming in. So why won't the government provide relief? And it's pretty simple. These companies are incorporated in tax havens, Liberia, Bermuda, and Panama, respectively. Had these companies been incorporated in the U.S. and paying taxes to the U.S. government, they probably would be getting some relief. I think the stocks for these companies have further down to go, and I wouldn't look into buying into them until they announce their next quarterly earnings report, in which they'll kind of give a forecast as to where the company's at. I know, I think it might be Royal Caribbean or Norwegian, one of those two. I think they're almost down to like sub $10 per share. So I don't believe they'll go out of business, but I have a strong suspicion that they may be bought if they do falter a lot more. Because I mean, it's a good business when the business is running, but in its current state right now, they are struggling to pay their bills because they have no revenue stream right now. There's no one wanting to go out on cruises and travel basically in a cesspool of people breathing in closed quarters.
Yeah, until operations resume, this is what we call a depreciating asset. They are spending money without making any money. So I generally would not advise people to buy a depreciating asset, even if you think it's going to start appreciating later. Wait for it to actually start appreciating again before you buy these companies. Um, I am watching gold and silver and Bitcoin right now. I'm probably not going to actually play Bitcoin, but this is one of those moments where I have started to take a little bit of an interest in them, um, mostly because of the Fed's massive money printing. There are some forces pushing these things up and some forces pushing them down. They at least look fairly stable at the current price. I think the dollar is probably going to continue downward as the Fed prints trillions of dollars more money. And so it's worth having some precious metals or some Bitcoin as a hedge against inflation right now. I would say don't get rid of all of your dollars because the dollar shortage probably hasn't completely played itself out either. But at least, like, you should maybe be like half dollars, half metals, something like that. I'm also watching oil tanker companies such as Frontline Limited. The business environment for tankers is actually really, really good right now. You wouldn't think so, right? With oil prices plummeting. But actually, tanker booking fees are at a record high right now because as the world's oil storage runs out, the oil producers are shipping all of their excess production further and further away in order to get it into available storage locations. So, Saudi Arabia is shipping oil all over the world in order to put it into storage. And so Frontline, this tanker company, has a dividend yield right now of 18.5%. And as long as the tanker fees stay at record levels, I see no reason that Frontline shouldn't be able to maintain that 18.5% dividend. So I actually bought this earlier this week and I made a 20% profit in it. And I think the stock should stay pretty strong unless major oil producers such as Saudi Aramco cut production this week. So I'm staying bullish on those until there's some sort of probably resolution in the Saudi-Russia price war. And I also think it's reasonable to start buying stocks with bargain dividends that look fairly stable. So Frontline is one example of that with a 18.5% dividend that they can probably sustain. Another example from this week that I bought into is Bristol Myers Squibb. This is a pharmaceutical company, a large cap pharmaceutical company, and they announced this week that they haven't really seen any business disruptions due to coronavirus, so their supply chain is intact, and they expect demand to stay stable this year. So really, it seems like this coronavirus thing hasn't affected them at all, and they don't expect it to. They also got FDA approval this week for a new multiple sclerosis drug, which in my opinion is a pretty big deal. I think there will probably be a fair amount of demand for that. So lots of good signs right now for Bristol Myers Squibb. And with a 3.5% dividend yield and no sign that they might cut that dividend this year, I think the stock is a bargain. So I will probably, I bought some this week and I will probably buy more if Bristol Myers falls with the rest of the market next week. All right. Well, thank you guys so much for listening. I hope that you are learning useful things from this podcast. If you are, please consider giving us a like, share, or comment. You can like our videos on YouTube. You can follow us on Podbean. Give us a review on Podbean or iTunes. You can also like us on Facebook. I've got a Twitter account that you can follow. I update the Twitter account a lot more often than I update the Facebook account. So you can sort of follow the latest market news on Twitter if you're interested. It's a nice way to sort of get more up to the minute news than you're getting here on this podcast. Of course, we can only update you once a week on the podcast, but if you follow us on Twitter, then you can follow the market news all week and get those sort of live up to the minute updates. So helps you be a little bit more nimble if you're a more active trader like me. And we also could use your support financially if you want to go to Webull and open a Webull account. We've got a link, a referral link underneath our YouTube video. And so if you use that referral link and deposit $100 into your Webull account, you get a couple free stocks. We get a couple free stocks. It works for everybody. Everybody wins. And that helps support the podcast and helps us make more of these episodes for you. So thanks so much for listening. Robert, you got any last words before we sign off?
Yeah, just make sure you practice social distancing and wash your hands.
That's right. Stay safe out there, and we'll see you back at the zoo next week.
See you.